The most valuable sportswear brand on earth just lost a quarter of its value in 12 months, $44, down from $80. The kind of drop you usually only see when a company is in trouble. So here's the $10 billion question. Is Nike the bargain of the decade, or a knife that's still falling? By the end of this video, you'll have a clear framework. The real numbers, the real risks, and the exact signal that tells you the turnaround is actually working. Let's get into it. Nike isn't a meme stock. It's a $46 billion business, a dividend-paying blue chip in nearly every closet on the planet. But a great brand and a great stock are not the same thing. So we're going to run this in 3 parts. First, the fundamentals, what the company is actually worth. Then the technicals, what the chart is telling us right now. Then a verdict, with the one metric that settles the debate. Stick around for part 3. That's where most people get this stock wrong. Let's start with why bargain hunters are circling. 1. The brand moat is still real. Nike did $46.4 billion in revenue last fiscal year. Even in a rough patch, that's one of the strongest consumer brands ever built. 2. It's cheap by its own history. Nike's price-to-earnings ratio sits around 20 to 27 versus a 3-year average near 28, and a longer-run average above 32. Translation: you're paying meaningfully less for each dollar of Nike's earnings than investors have for years. When quality goes on sale, value investors pay attention. 3. They're paying you to wait. Nike yields around 3.6%. and just raised its dividend again, about 2.5% higher. A cheap price, an iconic brand, and a rising dividend near a 52-week low. On paper, that's a value investor's dream. So why is Wall Street still nervous? Here's the uncomfortable part. There is no growth. Revenue last year was flat, actually down about 2% once you strip out currency effects. And it's not a one-quarter blip. Nike has gone roughly 10 straight quarters with no real revenue growth. Then there's China, long the growth engine. Sales there fell 12%, down to $1.3 billion in the quarter. And this next one is the detail most headlines missed. So pay attention, because it's the kind of thing this channel exists to catch. Last quarter, Nike beat expectations. Earnings of 20 cents versus 13 expected. Sounds great, until you read the footnotes. That beat was inflated by a one-time tariff refund of nearly $986 million. Strip that out, and the underlying margins actually declined. That's the difference between a business getting healthier and a business getting a temporary sugar rush. Always read the why behind the beat. And the pressure isn't over. Tariffs are expected to pile on roughly $1.5 billion in extra costs this year, squeezing gross margins by about 130 basis points. So put the fundamentals together. An iconic brand, a cheap valuation, a solid dividend, but no growth, shrinking in China, and margins under pressure. This is the classic value trap test. Something looks cheap, but it's cheap for a reason. A low price only becomes a bargain if the business actually turns around. So, is it turning? For that, we go to the chart. Fundamentals tell you what to buy. Technicals help you time when. Here's what Nike's chart says today. The stock is trading around $44.57. The good news, it stopped falling. It's been basing, moving sideways, instead of making new lows. Look at the moving averages. Price is above its 20-day average, near $42.93, and hovering right around its 50-day, near $43.62. That's a stock trying to stabilize. Not roaring back, but no longer bleeding out. Momentum? The relative strength index sits at about 55, dead neutral. Not oversold, not overbought. The market hasn't made up its mind. Which brings us to the 2 lines that matter most. Support sits near $40.75. That's the floor. As long as Nike holds above it, the bulls are still in the game. Resistance sits near $45.20. That's the ceiling. the wall Nike keeps bumping into and failing to break. Here's the catch. The recent bounce is happening on light volume, barely half the usual trading. A move higher that nobody's buying into tends not to last. So technically, Nike is coiled in a tight box, floor at 41, ceiling at 45. A decisive close above 45.20 on strong volume would be the first real sign buyers are back in control. Until then, it's a range, not a breakout. So, bargain or trap? Here's the honest framework. If you only look at the price, Nike looks like a gift, a world-class brand near its lows, cheaper than it's been in years, paying you 3.6% to wait. But price alone is a trap. The fundamentals say this turnaround has not started yet. Flat revenue, shrinking China, margins under tariff pressure, and an earnings beat that was mostly a one-time refund. So here's the single metric that settles the whole debate. The one thing to watch above all else. Currency-neutral revenue growth. The day Nike posts a quarter where real revenue actually grows again, and gross margins recover without a one-time refund propping them up. That's your green light. That's proof the brand is converting back into a growing business. Pair that fundamental signal with the technical one, a strong volume break above 45.20, and you'd have both the business and the chart confirming the same story. That's a far better setup than guessing at the bottom. Until both of those show up, Nike looks less like a screaming buy and more like a high-quality name on the watch list, one to track closely, not chase blindly. Wall Street seems to agree. The average analyst target sits around $51 to $59, a solid step up, but with plenty who rate it just a hold. That's the full breakdown, the numbers, the chart, and the why behind every one of them. If this helped you see Nike more clearly, subscribe. Every week we tear down one New York Stock Exchange company exactly like this, so you can invest with a framework instead of a feeling. Want the deeper numbers and the full watch list? The free breakdown sheet is linked in the description. Quick but important. This channel is for education and analysis only. It is not financial advice, and I'm not your financial advisor. Do your own research or talk to a licensed professional before investing a single dollar. What company should we break down next? Drop the ticker in the comments. See you in the next one.